Hey everyone, you're listening to the recap by Drawing Capital, the best place to dissect the week's key events and investing in technology in 15 minutes or less. The information provided is for informational purposes only and does not constitute an offer, solicitation, or recommendation regarding any investment product or service. Any reference is not an endorsement by Drawing Capital, nor a recommendation by Drawing Capital to buy, sell, or hold. Listeners should determine for themselves whether a particular service or product is suited to their needs or should seek professional advice for their particular situation. Certain statements on today's podcast may be statements of future expectations or other forward looking statements based on Drawing Capital's current views or assumptions and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied. Drawing Capital does not assume any obligation to update forward looking information, and any information discussed today is subject to change without notice. In addition, certain information was obtained from sources that Drawing Capital believes to be reliable. However, Drawing Capital does not guarantee the accuracy or completeness of the information obtained from any third party.
All right, with that, let's get into it. Today is Friday, March 12th. I'm here joined by both of my partners, Jugal, Lodaya, and Sagar, Joshi, just to provide a little bit of an overview. Where are we at here year to date? So, as of the close today, we're looking at the Dow Jones, which is up 7.12% for the year so far. The S&P is up a little over 5%. The NASDAQ is up 37 basis points. And ARK-K, the ARK Invest flagship innovation fund, is up 1.68%. All of this, a big change from last year and the previous year, with the 10-year U.S. Treasury currently at 1.63% yield, which was up from sub 1%, 95 basis points at the beginning of January this year. So big jump there. And the biggest impact really of this, what we're calling the Growth-quake and the sell-off in growth stocks from the middle of February, about February 12th through March 8th. And this week, major macro events that happened here. So Biden signed off on a $1.9 trillion stimulus bill. U.S. core CPI, also reported a couple of days ago, rose 0.1% from the month previous, and 1.3% year over year, which came in lower than estimates. In looking at the savings rate and money velocity, what are people doing in the country? The velocity of money is 1.13 as of fourth quarter for 2020, since it's reported in quarters, which has basically been declining over all of these years from 2.19 back in Q3 of 1997. Most interestingly, I think the savings rate is still currently over 20% for January of this year. That's up from the dip that we had in savings rate in November 2020 last year at 12.5%. And then the all-time high, just for reference, was in the middle or at the beginning of the COVID pandemic, April 2020, at over 33%. Just for a little bit of a historical frame of reference, the savings rate nationally since 2008 has generally been between a range of roughly low 4% to low 8% range. And for the broader economy, I think everyone, us included, are waiting on pins and needles here for Jerome Powell and the Fed's comments coming in on March 16th and 17th, looking for some commentary on inflation and whether we can be expecting some interest rate raises later this year. What are your guys' thoughts on comments from the Fed or anything else to add for the overview?
I think that's a great overview. Thanks, Sean, for providing those updates. In response to the quote growth-quake of recent market tendencies here, growth equities are shown to be long duration assets and therefore are sensitive to changes in interest rates. And so as we've seen a rising 10-year Treasury yield really forecast two things, either an economic recovery and expansion in America, which would be great news, or rising inflation expectations, which has a distribution of outcomes there. So that's a really component number one is the situation associated with rising interest rates, particularly on the longer end of the Treasury curve. And as a quick SPAC update as well, what we saw in 2020 with the huge boom in SPACs, about $83 billion was fundraised in 2020. We've now reached, just in 2021 alone, which is just about 2.5 months into the year, that number is about $80 billion already raised. So we're almost reached 2020 levels in just 2.5 months in terms of SPAC proceeds raised. So we certainly see that this SPAC surge has continued and will probably continue to occur, at least for this year and possibly in the new years to come. There are certainly a range of companies that are going public. And just like IPOs and just like direct listings, not every company is in the high growth category, and not every company is really should be going public. But nonetheless, it's a really pick the winners and avoid the losers type of an environment that we see with SPACs here today. Jugal, I'll pass it on
Before
to you.
before you keep going on the SPAC front, I mean, I think you guys have had a lot of questions from investors and just friends and family and things like this. But on the SPAC front, I think a big reason you're seeing a big shift and movement to that space is just how much money the SPAC sponsors stand to make out of the deal. What's your sense of how many of the SPAC deals are priced accordingly, should have the money flow that they're getting, and are actually a compelling investment versus something that just gets pumped by the sponsor?
Well, I think we are seeing some of this already. And in the past 2 to 3 weeks or so, we've seen a sell-off in several SPAC prices that were before deal announcement. And we've also seen a significant correction in some of these SPACs that were targeting specific trendy sectors, such as electric vehicles. We all know about the Nikola situation. And moreover, there is a distribution of outcomes at play. Some are exceptional companies that are looking for a high quality partnership with a sponsor that brings venture like scale to the public markets and the ability to fastly grow revenue and really drive significant value to their consumers and customer base. And then there's another cohort of companies that really have, let's call it at best, mediocre performance, that are basically in this arbitrage play of sponsors being able to take a significant promote in a company as another mechanism of fundraising and or earning a different distribution set of compensation there.
The whole thing about SPACs is that we've seen in 2007, there was around $12 to $20 billion of interest in money flowing into SPACs, and then we've seen the same sort of spike happen around 2020, and what we've seen thereafter is actually a large drop in SPAC interest, or rather a drop in prices for SPACs across the entire market in terms of this growth-quake that just happened. And I think there was just a lot of hype built up. There was tons of companies going public through these SPACs. A lot of them, a lot of these SPACs were bought up by retail that didn't do any sort of research on who the SPAC sponsors were. They didn't do any research on even what the companies that were being taken public were. They were primarily just in it for the hype and hoping that they could get a 20-30% free return on their investment. We've seen a huge drop in IPO A, B, C, D, all the way through F of Chamat Palihapitiya's SPACs, and I think that it's just uncovering a lot of the false hype that was around some of these investment opportunities, and how it just reminds people that essentially you can't just follow the crowd all the time, because you're going to get caught buying the top at some point.
Sagar, what's your expectations for? I know you're generally our macro interest rate guy. What are your expectations for Jay Powell's thoughts on 16, 17 of March?
Well, I think the market is having the expectation that there will be a continued low interest rate environment for the foreseeable future, or at least for the next few years. And the bigger question I think looms is, number one, is the amount of stimulus promoting economic empowerment and economic opportunity for multiple different socioeconomic classes? The second question is this money supply being translated into the general economy, or is it being trapped in the financial system? I think that is a very big question. And if I may, I'll take a moment to explain the difference. The difference is if all of this expansionary monetary policy stays within the financial system, this will, and we've already seen some of this, contributes to financial asset inflation versus consumer price inflation. The delta in these two is consumer price inflation measures as seen by the CPI or other indices. That is a measure of consumer prices versus financial asset inflation. One proxy of that could be measured as price multiple expansion, or in the private markets, a lot of private capital is seeking a lot of investment into a lot of startups. And there's a lot of money chasing a lot of startups right now. Coming back to this money supply situation, from about the past year, there's been approximately about a 25% increase in M2 money supply from last year's levels. And what that really indicates is that there's both massive money creation in the system as well as a high degree of expansionary monetary policy in play. And as a result of this, we're seeing some of these knock-on effects already emerge. For example, the steep rise in Bitcoin's price. Bitcoin has a scarcity element, but we've also seen it in collectibles. We've seen it in NFTs. We've seen it in art. We've seen it in a few other things. And so what this really means is that scarce physical hard assets are gaining more and more popularity. Equities and real estate are getting more popularity, and alternative investments are gaining more popularity. So rounding all of that out and coming back to your question, Sean, about interest rate policy, I think the Federal Reserve has communicated very clearly to both the general public as well as its cohort base that it gives commentary to, which is that they want to be very transparent with their viewpoints. They are focused on full employment. They're focused on inflation, and they're focused on financial stability. And if those goals are not quite being reached, they seem to be continuing this expansionary and stimulative trend, and probably will continue for the near term at least.
I think the biggest concern I see across things like Twitter and just around talking to people is like, when does the inflation end? At like the rate of inflation right now is quite incredible. It makes people kind of confused at like how we can continue to print money out of thin air when we already have so much debt to pay back. But just going off back to that point about Bitcoin, it's really opportune that the inflation is occurring right now when Bitcoin is also in the end of its 4-year cycle, which happens every time it halves. And this is the time when Bitcoin is expected to rise. And so the inflation that's going on from the Fed is actually accelerating that growth in Bitcoin. And it's just really interesting how these sort of things align so perfectly. Had this sort of thing happened 2 years ago, I don't know if we would see the same growth in Bitcoin that we're seeing today.
Yeah, I mean, just numerically, right, too. A year ago, a price of one Bitcoin was $3,800. Bitcoin price today is $57,000. So you've got a $53,000 per Bitcoin price appreciation over a year, which is just astronomical. But it's, I would say, equally as astronomical as the level of money that's being printed. And I think when we look at basically the divergence between money velocity, money being printed, I think an interesting thing to look at also is just because there's so much money and so much being saved and sitting on the sidelines, it's just how is that money getting spent going forward? Powell's expecting this to be a transient event where, obviously you're not going to go to Hawaii 6 times. Maybe people will take one big trip and you'll have a surge in inflation and it'll come back down to earth shortly thereafter.
Yeah.
We're just running out of time here, but any final comments, you guys, for the coming week or coming months?
I'm just looking forward to another sort of rally in the markets after this sort of growth quake that occurred. Historically, we've seen this sort of thing happen, every so often, and every time after, the growth stocks continue to rally after harder than they did before. So I think people that are worried about seeing a 30 or 40 or 50% drop in some of their high multiple names, they should, first of all, be cognizant of the fact that these names were high multiples and they contracted a bit, but they should also be cognizant that historically these things do come back and they do potentially rise higher than their previous levels.
Excellent point, Jugal. I guess to answer your question, Sean, as a closing thought, I'm really looking forward to the reopening of the world, really, with these ongoing vaccine distributions. Hopefully, there's improving health in America and abroad, and it's just really fascinating to see that as more and more individuals get the COVID-19 vaccine, how that really just changes people's behavior and the like. I know it's been over a year now since the outbreak of this really started, and of course that will have so many impacts, from education to technology to just a way of life for many people, whether it's remote work or going back to the office. And so it will just be fascinating to see what happens in the second half of this year. But I'm just really hoping that the health of the world just improves. And kudos to the entirety of the biotech community, the frontline healthcare workers, and everyone involved in finding a vaccine and doing all of the hard work in getting the distribution involved and the coordination of all of that. And of course, there will be talks on was it suboptimal or not in terms of distribution. But the reality is that over the next few weeks and months ahead, it seems to be that these vaccines will be distributed in mass to millions of people. So I'd like to end on an optimistic note, and I think that that's going to be the new reality going forward. I'm just looking forward to kind of meeting all of you guys in person there.
Yeah, you and me both. All right. Well, thanks everyone for joining us. Please join us next week when we'll be rehashing everything to come over the next 7 days. We look forward to seeing you then.